Well, I would think if we go to 1.25, Kelly, trade deals off the table. The market is pricing in even more rate cuts than the Fed is already projected to have, and so I think at that point we are almost recession bound or very close to it. But most of the news that we've seen of late have just favored the bond market as people exit stocks and go right into bonds.
You know, Kevin, I would have thought, sure, that makes sense before we got a month, meaning the June data, which came out in July for the U.S., all better than expected, all pretty strong overall, and yet bond yields sank like a stone. So they don't seem to be data dependent.
No, you could almost throw most of that data out. I think hopefully this week we'll get a better fresh round of data that may be more current. But and I can't tell you whether it's the fleeing of the equity market that's benefiting the bond market, or the bond market thinking that they've got to catch up to where they believe the Fed's going to be in the next 2 or 3 months. So I think it's it's really hard to gauge how much lower we can go.
Right.
But it's certainly a play in the game that we don't know the rules for right now.
So I understand that people say, look, compared to the rest of the world, U.S. yield is relatively attractive, and that's why we're still seeing buying at these levels. And yes, I mean, given what the Fed's talking about, we could go lower from here. If they're already talking or doing more bond buying than we thought, if they're talking about doing more in the future. But my question is for investors in fixed income who are looking for, to these products for some security, for retirement, for just that defensive nature of their portfolios, do they need to rethink that right now based on how extreme some of these levels are getting?
I think they do. And again, quality is king here, Kelly. I think that if you want to stay in the short end of the market, there's still value in the corporate bonds, and I'm talking about higher quality corporate bonds versus high yield. That'll give you a decent resting spot. It's not a great yield, but it does give you a chance to ride this thing out a little bit. If you're a longer-term investor, the tax-free municipal market at 100% of taxable yields out on the long end gives you not only credit quality, it gives you yield as well. So while it's not the prettiest game out there, there are still some value propositions for bond investors.
Kevin, when I spoke to you last week on Squawk Box, you had indicated that you thought the 10-year yield would go to 1.35% fairly easily. Do you still see that? And is there, I'm just curious, is there a time, I mean, it's a 24-hour market for treasuries, but is there a time of day where you think things will get pushed around a little bit more than others, that there's more danger involved?
So we haven't really seen the stresses yet that might indicate that we're going to kind of on an elevator shaft down to 135. So, IG last week priced a number of deals where spreads were tightened. They were oversubscribed. The leveraged loan index in particular has dropped a little bit, but not anywhere near it was at the beginning of the year. So, right now it would take almost a complete give up on the thought that the U.S. and China are going to have a trade deal before we kind of cash in on the economy and see yields fall much further than this. We're all adjusting our levels down. I'm at 1.5 right now. But, there's what's to say it can go to 135 or even 1.25.